Hello there. Welcome to our State of the Markets. We're talking about inflation, rates, performance, a whole bunch of things today. Nate should be joining us via video shortly. He's here via audio, but Dan is, he's got his hair on fire as he's bringing on Nate's camera in a second.
But I anticipate that this, and I don't know this to be a fact, but I anticipate this to be how all kind of audio technicians work, like pre-broadcast. I believe this is what it's like.
I think so.
Right. I think this is right, but you can't ever see that because when the 10 o'clock news comes on, you just see the anchors and that's it. But I assume that 2 minutes prior, it's a little crazy.
That's exactly true. So, as we go along, Nate will show up in a minute. But the big thing is we got the slides up here. So we're in good shape for all of those that have accessed the recording. Thank you as well as we go through 2022 year in review so far. So we ended the second quarter. We wanted to give you a little bit more information on what's going on, some of the trends that we see, and then also just talk about where we're at and where we're likely going. So we'll start this off as we love to do, which is to start with a disclosure slide, just basically stating that, hey, anything we talk about in this, any prognostications, things like that are just our educated guesses. Your own personal situation is vastly different from just what's going on in the economic situation in the nation. So please don't just take this and run with it and make a bunch of changes in your portfolio. Talk to a qualified professional when taking this advice and implementing something in your own portfolio. So again, thanks for joining us today. Wanted to give a little overview on what we wanted to talk about. Definitely some performance and where we're at year to date in the stock market. Talking a bit about other markets as well and how some of those have been impacted by our current economic situation. Treasuries and mortgages. And then talking a bunch about one of the main things here, and that is, where are we at in the federal funds rate and where are we at in inflation? Inflation is just a huge topic today, and we'll talk a bit about that. That's probably, I would say, the most important thing in talking about the yield curve inversion. And then if we have any questions that people ask, or we'll ask each other some questions as well as we go along. So Q&A is very fluid, and if anybody has anything, just type it in the box below, and we'll get to that. Otherwise, we have some other questions that we might ask along the way that people have submitted prior to the webinar. So thanks for taking the time to do that as well. So when we go into year to date, what has happened in the stock and bond markets, this chart here that we're showing is just generally the S&P 500. So the 500 largest companies by market capitalization. There's a fund that tracks that. That fund is SPY. Any funds that we give you during this time, we're just showing it for illustrative purposes. It's basically showing the index. It's supposed to replicate that. And we also show you the total bond market index in that chart. So what's striking on this is, and everybody knows, the stock market is down this year. And, it's down about 17.5% as of a couple days ago when we ran this chart. It's kind of treading water today. And, I think the biggest story on this is really the bond market. So the stock market, if we would go back, Nate, and we'd say, hey, look, we had a Ukraine and Russia war that got started. We have inflation that's running pretty hot right now, and we'll go into how hot that actually is. We have corporate earnings that are slowing down, recessionary fears. How much would you think the stock market would be down year to date? I mean, I would say, I don't know what your number would be, Nate, but I would say, if you had to give me all that lineup, I don't know, maybe 15 to 20% down.
Yeah, I would have said 20 to 25, but yeah, I mean, I would have been right in that range. Yeah, in 20 range.
I mean, so I don't think that what we're looking at here is totally crazy. I mean, people are like, oh, the market's bad. Yeah, the market's bad. It's off of its highs. We'll talk about historically speaking, where we're at valuation wise, but if you told me that, I would say that seems reasonable to me.
Yeah, that seems like the right recipe, if you will, for a roughly 20%, one way or the other to another 22 to 18, maybe somewhere in that neighborhood. That would seem reasonable.
Yeah, exactly. And now if I told you, oh, the bond markets are down 10.5%, I mean, what sort of reaction would you have to that?
Yeah, that would make no sense other than, not knowing any other information, right? That wouldn't make sense because you would think, well, the money that's generally invested generally stays invested. It just simply flows, and when we get into times like this, to a different, in a different direction. Or it doesn't come out of investments. It flows from stocks into bonds, right? So therefore, bonds rally, bonds do better, and so that's kind of the natural evolution of markets when we get into volatility like this. But that's not what happened this year.
No, and diversification really hasn't helped you very much,
right?
Unless you were heavy in like commodities, something like that. Right. But even if you were in one of the most safe haven of assets, gold, that didn't really help you at all this year either. That's basically treaded water. I mean, it's a really interesting time right now because stocks and bonds are falling together. I don't know. You look at the chart. I don't think you could argue that they're correlated. I think it's more correlated to, say, interest rates.
Right. I think to your point, it's correlated, the first 6 months of this year because of the characteristics of the first 6 months of this year, right? I think it's almost they're correlated as a result of what's happened, not because of any other reason. They're correlated because we had the right mix of variables that pushed both of them negative.
Right. And I would say also in this situation, what's interesting about it, this is a historically bad bond market.
Yeah.
You're talking it was 18, I can't remember the exact date, and maybe you can help with this, Nate, but it's like correlated. It's like in the 1800s when we had a bond market this bad right now. So it is a historically bad bond market. And when we look at the stock market, this is kind of a, I would call it more garden variety. It is a bad start to the year. It is kind of a historically bad start to the year, but not anywhere near where bonds are at today.
Yeah.
So I think it's interesting. And then if we look to, okay, so we have this year to date. But let's look at the 5-year chart. I mean,
right.
that's where the rubber meets the road. And you're saying to yourself, okay, well, stocks are still up significantly in the last 5 years. If you would just say, okay, I went to sleep, one day and then I woke up 5 years later and I came to you and I said, hey, look, you're up about 75%. You'd be like, it's pretty good.
Yeah. But to the point you're making, Clint, I think you're exactly right. When we frame in kind of what's happening. And I think that's what gets lost most when we talk about market investments in general is people tend to lose perspective of what's going on. And I think that's why the emotion runs the way it does. We lose context, i.e., right now everybody is gauging everything off of the first 6 months of 2022's returns, and that's all we're looking at, right? We're losing sight even of what a 1 year looks like, let alone a 5 year. And again, I think most people, if given that 5 year chart, would be pretty happy to say, wow, okay, my investments grew significantly in the last 5 years. They wouldn't necessarily focus on the fact that, yes, in the last 6 months, the market's taken a lot of wealth away. But unfortunately, that's just how we operate as humans. We tend to frame things in today's light, not in, even a week ago, let alone, 5 years ago. And so the flavor of the day is a negative stock market. However, if we look at it over a 5 year, again, within context, it still looks pretty good.
That's exactly right. And I think the real story here is if we look at the last 5 years in the bond market.
Yeah.
I mean, and if you extend this chart out another, 5 years too, I mean, a lot of the gains in bonds have just all of a sudden gone away. And so it's been a pretty shocking bond market right now, whereas it really doesn't provide that sort of buffer that we're commonly used to. So, hey, it's a strange bond market out here. So, we're at only a 4.35%. This is a total return over the last 5 years. So, I mean, that's like just over CD level, that's like at CD level returns right now. And you're talking about the duration of these bonds. These are a lot of government bonds inside of this bond index. It's like a 7-year duration or so when we look at that. So, I mean, you're not getting paid off for taking additional duration in your bonds. You're barely getting paid off for the risk that you're taking in those. If we would have looked at, from this 5-year period, if you had money in those funds. So that just goes to show about how extreme this bond market is right now. And we're not saying that you shouldn't, invest in bonds or anything, or that you should pull all your money out of bonds. we're just looking at it sort of in context. How does this all impact everything? And that's where we're at right now.
Yeah, I think that's the as you said, the bigger story in the bond market is the start of the year this year. But again, from a context view, it's concerning because the last 5 years in bonds have just not given us what people are used to. Especially if we take this chart back, 10 or 15 years, you see a more kind of normal. The result is a more normal result within the bond market, and in the last 5 years, it's just not been there. Right. It almost feels like the way that stocks felt in the first decade of this century, kind of the lost decade as they were known. It almost is what feels like, or what the bond market feels like over the last 5 years.
Right. Exactly. Yeah, I agree with you. So, moving on to the next slide here, when we go through returns again. Again, that 74.99%, that 75% S&P 500 return. And then in here we have, small cap returns as well as that green line. That's at about 44% for the small caps. So it does go to show that large caps have really led the day for the last 5 years in the U.S. And then the same old story. International stocks are still lagging. And you can see in this chart here, there's only one little period of time where international really took off and went above, domestic stocks. And, that was right around 2018 there in the chart. Now, they've lagged by so much. So when we talk about, the whys of that, everybody's seeing inflation. It's not a U.S. phenomenon. It's a global phenomenon. But that being said, the strength of the dollar does have some negative ramifications for investing in international stocks. There's a currency conversion in there. That's part of the reason there, and their growth rates in general haven't been as strong as the U.S.
Yeah, this is an interesting one. We talk about the international markets. It just seemed like they lagged coming out of 08-09, right? Lagged our economy, lagged the domestic economy. We recovered faster. They took longer to recover, and then that didn't run necessarily right into the heels of COVID, but they kind of went from a lagging or a dogged recovery out of 08-09, and then relatively shortly thereafter ran into COVID, and so they just they haven't been there, and we just keep waiting. And that, I think the title to this slide is perfect. Same old story. Everybody keeps waiting and waiting and waiting for international stocks to do what international stocks typically do, right? Which is, they can go on runs, especially in the emerging markets. They can go on runs that dwarf the rate of return of the domestic stock markets, and they can also get hit harder when things don't do well. Again, pretty atypical that we have a period of time of this long where international stocks just haven't, right?
They just
haven't, right? Yeah. And that's, I don't know when they're going to have their day in the sun again, but we're still waiting.
It's highly likely to be. One of the things is going to be when the dollar starts to weaken, and
right?
You'll probably see that as it seems like Europe and others are starting to raise interest rates very slowly, and they're just not in front of it as much as the U.S. is. So
right.
I think once we start to see that, you'll see the conversion, the currency conversion flip a little bit, and then eventually we'll see what happens here. So
yeah, and Sil and I spoke about that in a recent podcast, just the strength of the dollar itself and kind of what is driving that and kind of the impact that it has for not only domestic markets but ex-domestic markets, as well as multinational corporations that may be based in the United States but do a lot of work in global economies, and it has an effect that is much more powerful than I think the average investor realizes. And a strong dollar, and the point we made in our podcast was, a strong dollar isn't good, it isn't bad. A weak dollar isn't good, it isn't bad, right? It's just a different kind of batch of goods and bads depending on whether you have a strong dollar or a weak dollar. But as of right now, the strong dollar is making it difficult on the international markets.
Yeah, exactly. And, you can hedge out some of that currency conversion by the use of certain funds, but in general, we generally don't. So that's kind of an interesting deal there, is that we generally don't, because it's going to ebb and flow, and every once in a while, you're going to get that kind of pop from that conversion, and then there are times when you don't. And right now, when the dollar's strong, that actually kind of helps you as a domestic investor anyways. Because most people have more domestic stocks than international stocks. So, all right, we'll move on to the next slide. And I think this is one that is near and dear to your heart, Nate, because you always love to talk about mortgage rates and things like that. And commonly speaking, this is the great fallacy that people have. When the Fed raises interest rates, people believe that mortgage rates definitely move in lockstep with that. That isn't necessarily the case, and they're probably looking at the wrong metric.
Yeah, that's exactly right. So typically mortgages are priced off of the 10-year treasury. So when we look at the 10-year treasury as a meter, if you will see a fairly strong correlation between that and mortgage rates. Now, it's not again, even that as being the kind of the best comparison, it's not one for one. Companies still are independent to price their mortgages as they see fit. And even within local markets, it's interesting because you'll look at competing credit unions and banks, and even they won't have the same rate for the 30-year fix. So let's be clear, first of all, that mortgage rates are not a priced thing within the market that is exact across the board, right? It just as every grocery store might have a different price for a gallon of milk, mortgages can be priced differently depending on the institution. But if we kind of get deeper into your original point, Clint, I think when people mistake moves within interest rates, what they're mistaking is that the Fed moves a very short rate by which banks and credit unions borrow money from each other, called the federal funds rate. And so they're very, very likely to raise rates, and this is a prognostication. This is just our guess, but they've indicated that they're looking to raise rates by another 0.75 of a point by the end of July, right? You will not see mortgage rates that day just go up 0.75%, right? So that's not gonna. I mean, if it does, it's just coincidence that happened. It's not because one drives the other. But I think the bigger point to this is, what is it doing to the overall housing market, right? And then how does that relate to the economy as a whole? Because we have had an incredibly strong housing market for the better part now of, more or less going back to 08, 09, probably more like, 2013, 14, 15, somewhere in there is when it really started to roll. So you've had an incredible market within the real estate. And primarily when we talk about that, we're talking about domestic homes. We're not really getting into commercial properties and industrial buildings and things like that. We will see what this incredible rise, and I say incredible because it really is, this rise in mortgage rates, 30-year fixed as of January this year was around 3%. It's now in the 5.5%, and it even touched 6% about a month ago. We'll see what this does to the housing market. I don't think you can double the 30-year fixed rate and have the housing market continue to roll the way it has the last 5 years. I have a hard time believing that doesn't slow down. And I absolutely understand from our real estate professionals and friends that we have in that industry that we still have a housing inventory problem. I understand that, and I agree with them. I just don't know that you can essentially bump the cost to the borrower by that amount of money, i.e. the 30-year fixed being double what it was, and not have that affect demand. Because if you think about what that actually does to a housing payment every month, it makes it more expensive to buy the house, even if the house price didn't move at all.
No, you're absolutely right. And, in this situation, I saw just a recent article that said that a whole bunch of transactions are not closing now. And so what's happening is there's a bunch of accepted offers and a bunch of people are dumping out of it. And it's because of financing. It's not necessarily, maybe they have a contingent financing contingency in a lot of the offers they do, but in a lot of them they don't, but then they might be finding a different way. They might be getting out of the deal just because of just because they find a bad inspection item or something like that, and they're just removing themselves from the sale. But a significant amount of these are not closing. So
a significant amount more than did, say, 2 years ago.
Correct.
Right. I think I think that's the point, which is, it's a great point, because typically when we see housing markets go through, the backside of the mountain, if you will, or kind of come off of their highs, it doesn't generally start with big, kind of explosion type things, if you will, like what can rock the stock market. We can see the stock market lose 2,000 points in a day. That's not typically how real estate markets fall. Typically they start with cracks. Those cracks get bigger, and then before you know it, the market is seeing price drops and 2 months to sell a home, not 2 days to sell a home. So typically the housing market doesn't work the same way the stock market. When it starts to slide, it's generally a culmination of 3 or 4 smaller factors which all start to take hold at the same time. And to your point, higher payments led by higher mortgage rates, led by consumers getting a little scared because of what the stock market is doing, because of the inflation numbers they're seeing. All of these things are starting to eat away at the real estate market. And I wouldn't be surprised if you don't see it feel some pain here in the next 12 to 24 months.
You're exactly right. And coming up on the heels there, let's talk about the big thing right now. And that is today, I just, I sent this over to Dan this morning because, this printed out and futures immediately went down. You were watching futures today, Nate, and all of a sudden you're like, oh my God, futures just turned negative. And now it's been kind of up and down today. But so the U.S. inflation hit the 4-decade high of 9.1%. And that's a pretty incredibly high number. I mean, we have not seen this in so long. You see that. And then, the secondary secondary headline here: rising housing costs are putting pressure on prices, but lower gasoline costs and a glut of retail goods could be the turning point in inflation surge. So, I mean, everyone's trying to call, when is this inflation surge going to start abating and how quickly?
Right.
And then that's the sort of thing that the Fed is dealing with right now. And, I don't want to bang too much on the Fed, but, as of, I think it was February this year, they were still basically saying that inflation was contained and it was, essentially transitory.
Right.
And then all of a sudden, it's not quite related. It's not quite the Fed, but Janet Yellen came out and said, that she made a mistake. She thought she was wrong on inflation. And Chairman Powell has been now kind of admitting, yes, inflation is here to stay and we need to do something about it, and the Fed is going to get more aggressive. So the rhetoric has ramped up, and then some of the policy has ramped up as well. I mean, we went up at the last meeting, they went up 0.75%. There's another anticipation that we're going to go up again, another 0.75% in interest rates. And that's the short-term interest rate that everyone kind of watches. What is the Fed going to do? Because the Fed only has an influence on really the shortest end of the curve. In regards to those policies, there are other policies that can have, impacts on the longer side of the curve here. But, when is inflation going to start to abate? And those are great questions. And so if you take a look at our inflation rate here, you could see that, is it unprecedented? No, there have been periods of time. You could see 1980, which, a lot of the people that we know 1980, they know that, that those times were extreme, and we had interest rates that were just extreme interest rates. And we essentially put our economy intentionally into recession to keep that overheating. But I mean, this is definitely new to us, new to many investors, especially young investors. They've never invested in an inflationary environment. Really.
Yeah, I mean, think about it. A lot of us that have a gray hair or two. You talk about the early '80s, and just because of maybe trying to make ourselves feel better, it doesn't feel that far away, right? But I mean, you're literally talking 40 years away, right? I mean, it's 4 decades ago. That is a long period of time within how we look at markets and things like that. It's not long in terms of history, but it's long in terms of how we look at markets and kind of when we consider kind of more modern markets or more modern characteristics that are driving our markets. Especially, I mean, at least if you look at it from, the industrial age, and then beyond, right? That's kind of more the modern time that we tend to focus on. this is historic. You call a 40-year period of time historic. And so you bring up a great point, which is, and I think this is the reason why this is so surprising for people, is that it's hard to remember back to the 80s, obviously. And for some people that listen or that are investing, they weren't alive at that time. So it's not their fault they weren't aware of what was going on in the 80s. But it's back now, right? And I think one of the mistakes that people are looking at with inflation is the assumption that once it peaks, right, and starts coming back the other way, well, then it's just going to fall right back down to where it was, right? Well, maybe, right, but I don't know that that's as guaranteed as we might think. This might still be a problem 5 years from now, right? And I think that that's what people need to start to get their arms around a little bit. Is inflation is one of those things, and I agree with your point, Clint, which is the Fed has some blame in this, but I think people are overdoing that and just bashing on the Fed. Inflation isn't a problem until it's a problem. And once it's a problem, you now have a really hard time fixing it. So it's a very difficult animal to deal with, because you don't want to fight a problem that's not a problem. But once it is an actual problem, like this chart indicates, it's then too late almost to fight it, or it becomes very difficult to fight it. So it's just it's a tough needle for the Fed to thread. And right now, we're looking for any indication that it could abate or fall back. My message is, yes, we want that, but let's not be under the assumption that it's just simply then going to go from 9.1 as the rating came out this morning back down to 2. I mean, that's probably not going to happen. So, there's some other there's more headlines that need to come out even once it crests and starts coming back a little bit.
Yeah, and you look at where it's dropped. I mean, the Fed was extremely aggressive there back in 1980, but let's say more recent history even. I mean, look at where that inflation rate crashed down. Well, that was 2008. I mean, so we had an extreme event that caused us to enter a recession that was pretty unprecedented since the last Great Depression. So, I mean, we had a very extreme event there.
Right.
And another one there in COVID. You could see a little dip down too in the 2020. So those are big events. Right now, we have some big events going on. Obviously, the Russian-Ukraine war is a big deal, but when we're talking about something that has an impact globally, financially, that has an impact, but it's fairly small. There are other impacts that are being felt, throughout the world, and those are supply chain constraints and things like that. So there are some definite things that are driving this inflation, and unless we have some sort of really fast recessionary event, which I don't see, our inflation might stay persistently high until the Fed really continues to hammer these interest rates higher. And
I think that's the point that we're at right now, and that's why it's as concerning as it is, because it's at a high level right now, and obviously if it were to abate and start to fall back down, I think everybody could take a little bit of a deep breath, and we could kind of assess and see where we're at. And maybe that doesn't mean that it's, quote, over, to my previous point, but maybe just give a breather. That's not guaranteed to happen, right? I mean, 9.1 was the number this morning. That number potentially could be, X plus whatever you want to put on that, 6 months from now, 12 months from now. And so the Fed, to your previous comment, all they're going to do is just keep swinging higher rates at it, because that's what they need to do to try to get it under control. So it's hard to see where this potentially stops, but we're at a spot right now where it's concerning to a lot of people.
Yeah, and so the next slide gives us a great indication of that too, and that is, the inflation rate versus the Fed funds rate. And what's been going on since 2008 has been unprecedented, and I think people just got used to it. You can see where the federal funds rate on this chart, it's in orange, is flat, near zero for a really, really long time. Essentially 2008, and then finally they started to bring it back up, and then COVID happened again as they crashed interest rates back down again from the short-term perspective. That's not normal.
Yeah,
I mean, we never really went back to normal. You started to see it sort of normalize pre-COVID here, because you see here, it's marching up. In here, it's kind of marching up with inflation. It makes sense. And then COVID hits, and all of a sudden, okay, we have an unprecedented financial situation. We got to bring all the interest rates back to down to zero. There was a long period of time, though, between 2008 and 2015 where those interest rates, maybe even a little further than that, but we really had no movement in that. And we were in this sort of this big stimulus situation and these low interest rates, and it took forever for them to finally hike those. So, if we look back, and I think this is where we learn something from the past, if we look back, you see the federal funds rate is generally, if we took normal times, is generally above where inflation is. Well, we're at like 1.5.
Yeah.
And the inflation rate comes out as 9.1 today.
Yeah.
So what should the federal funds rate be? A heck of a lot higher. And we're talking about like a 0.75% change in that. That's nowhere near where possibly we should be. So that,
or may need to be.
Yeah.
Right.
So this, and this is going to sound so weird to say this, where we're in right now, we have a highly stimulative monetary policy still.
Yes.
And so there might need to be significant rate increases here. And this should make you feel like if your hackles are kind of going up and you're going, this makes me a little nervous, this is what keeps us up at night. It's stuff like this. And we'll show you the yield curve inversion in a little bit too. But I mean, this is very important right now because we're watching inflation very closely, because if the Fed has to continue to make super aggressive moves to tamp down inflation, it's going to put us in a recession. And we've seen, a lot of prognosticators out there say, hey, are we going to enter a recession soon? It seems likely in my eyes that we're going to enter a recession soon. And and we've talked about this in front of clients too. There's a possibility, a small possibility, but still a possibility we're already in recession.
Yeah, because I think what needs to be discussed is that for the average person, recession is an economic kind of title that we put on a period of time that is going to define or hallmarked, if you will, or benchmarked in characteristics of a slow economy, right? So we tend to have unemployment go up. We tend to have consumer sentiment go down. We tend to have consumer spending go down. We tend to have discretionary things that don't run at normal levels because people are kind of pulling the reins back in, right? But for most investors, that's not really what they're talking about with recession. What they're talking about is what impact does that have to the stock market, right? I mean, that's really what they're talking about. And so whether we are or not in recession today or yesterday or tomorrow or a month from tomorrow, really what the average investor is asking when they talk about recession or thinking about is what impact does this have on the market? And I think you're already seeing the market pricing this in because the market tends to be in front of economic developments. They tend to price those in before they happen. So we're already seeing a stock market that, to our view of the world, has already priced that in. To what level it's priced it in, we don't know yet, but it already feels like the market has priced in some sort of recession. If we can speak for the market as though it's a thing, right? Even though it's bounces around like a rubber ball sometimes. It's kind of already made up its mind that we're in recession.
Well, you could see that with a lot of the earnings guidance that are given by companies and some of the things that you've seen, the signaling that they're giving. I mean, you're starting to see employers, especially tech, they're starting to lay off some of their workforce. They're starting to kind of right size or trim the fat, a bit. So you can see them pulling back on that. And then the earnings guidance isn't as robust as it was. And a lot of them are citing these concerns, right? Inflation's a problem. Right. Supply chains are a problem. Costs are just higher across the board, and the wages are, increasing as well. So you have to pay your people more, or you have to start laying people off, or you have to start, if you have price elasticity, you charge your customers more. I mean, it's just all these different things that have to occur. And so when these companies get to the point where they can't pass that on to consumers anymore, that's when you start to see them.
Yeah, I just had a conversation with this about my cousin over the weekend. He's in the transportation industry, and that was basically his comment, because we were talking about the price of gas, and he's like, "Well, it's just basically, the thought is it's just going to flow back to the end good anyways. I mean, because somebody has to pay for that, right? And it's kind of, it just kind of flows down until it gets to the actual product itself. Then the price of the product goes up, and that more or less covers the fact that gas costs more money and labor costs more and supply costs more and all of that. So that's why you're seeing prices going up on these things, because you're not going to have one of the middle companies, if you whether it be the manufacturing company, the transportation company, the marketing company, they're not just going to pay the higher cost. They're going to continue to pass that down, and it ultimately ends up hitting the consumer. That's what happens.
And then if the consumer says, I'm going to substitute, or the consumer says, I'm not going to buy that anymore, that's when you start to see that price elasticity ends up being, okay, we've hit that upper point where I no longer can pass that on. And so, that's really this market, which is really funny. This whole thing that we've talked about so far comes down to supply and demand. Our demand is still really high. We have too much demand right now, and it's chasing too few goods. So then our prices go up. That's inflation. We have supplies constraints sometimes. We have, kind of over demand sometimes. And some of this will work itself out, just because if prices become too high, well, demand will start to curb, and it'll actually bring inflation the other way. So there's a lid on where inflation is, and we don't know where that lid is.
Yeah.
But we're going to hit that at some point here coming soon, because people are going to be like, yeah, I can't tolerate $8 a gallon gas.
Right.
And you're like, okay, well, once you hit that, then the demand starts to wane, and airlines can't charge $1,000 for a ticket from Madison to Denver. There's going to be a point where you just go like, I can't do that as a consumer, and then demand again wanes. And that's generally recessionary. So, if you're hearing us talk, and we're not trying to sound overly dire, we're just saying, like, realistically speaking right now, it looks fairly likely that we are either in recession or entering recession. And the faster that inflation comes down, the more likely that we see that the markets bounce back positive at that time, and the faster that we kind of recover from this.
Yeah, and I understand the message we're sending to the listeners that might look at it and go, well, okay, so therefore we need to get out of all of our investments. Well, that's not really the right sentiment for a few reasons. One, as we talked about earlier, the market's already priced this in, right?
At least somewhat,
right? So the fall in the previous, the S&P 500 chart that we showed, that's already there, right? So, I mean, in a lot of cases, the getting out of the way option or idea doesn't work, because for that to work correctly, you have to get out of the way before things have gotten bad. Well, you don't know that they're going to get bad. So there's kind of flawed logic in that, in and of itself. But more importantly, the reason why we don't believe in that philosophy is because recessions and markets downturns and things like that, these are natural parts of the market cycle, right? This is not atypical. And that's what I think that people really want to hammer that point home, because I think we like to call it atypical. We like to say it's a new normal. We like to say all these buzzwords that we come up with in the media. This downturn isn't any different than the other downturns that we've seen. Yes, the headlines are slightly different, the reason why, the characteristics of it, but it doesn't make it such that, oh my gosh, this is different than the previous 10 recessions that we've had. Yeah, they're all slightly, they have their own characteristics, but it doesn't mean that the net result is any different than the previous ones. And what's happened after, in my example, all of those 10 recessions have kind of played out. What happened? The market rallied back, the market found new highs, and the market went to better places. And this is what happens. This is why when we understand what these kind of scary headlines mean overall, what it means is the market is going through its natural cycle, and the economy is going through its natural cycle, and it will go through the ugliness that we have right now, and it will come out the other side, because it's never not done that.
Well, right, and some of that supply and demand that we're talking about, the simple economic truths that we know, the supply eventually, because we live in a capitalistic society,
right,
the supply will replenish itself at some point if the demand is still there. So, we will have that supply coming back, and then, we'll have more of that. And you could see it actually already in inventories.
Yeah.
Right. Apparently all these retailers thought, okay, we're post-COVID now and we're going to buy a bunch of inventory. So they bought a whole bunch of inventory. They're sitting on huge amounts of inventory. Well, what's looking now is that they have too much inventory because, we might be going through an economic correction here.
Right.
And so therefore, they're going to have to discount those. Well, what does discounting basically mean? Well, discounting is deflationary, not inflationary, right? So prices will fall and people will, possibly be enticed to buy more goods there, but at a lower price. So
right.
That means
that becomes stimulative. And then therefore the economy starts to get better because it's a stimulative effect. And so these things are all intertwined and interrelated. And we're not trying to oversimplify. What we're trying to illustrate here is that the basic tenets of economics and market investing come through regardless of whether it's the 80s, the 70s, or the decade of the 2020s. These kind of basic concepts will ultimately show themselves to be true again. We just have to get past some of the clutter and some of the scariness of the headlines.
Yeah, so I want to give a final last few charts here because I think these are great. First of all, we'll give you a good one. So here's, hey, we have some good news on inflation because after the print today where they're like 9.1%, let's show you why inflation may have peaked. So here's the narrative of why inflation peaks. This chart right here is year over year personal consumption expenditures. So it goes through, and that's just a fancy way of saying we're going to scrub out, some of the things that might not, that might be a little too volatile. And this is the one the Fed really looks at when they're doing interest rate policies. So there's personal consumption expenditures, which does involve gas. And then they do core PCE, which actually takes out gas.
Yeah, and just a quick point on that. Typically, gas and food in a lot of inflationary measures are not included. I think that's something that a lot of people don't understand. Those are taken out because of the volatility of the prices of those goods.
I always kind of laugh at that because it's like, oh, do you consume gas and food?
So, right, yeah. It's kind of a silly one for me too because you're like the average household, yeah. Fair amount of gas, fair amount of food. So, yeah. Okay.
If you're talking about major consumption things, but regardless, they are volatile. We all know that. Like gas prices have been everywhere this year. So, we get it. Mostly higher, obviously. But, in here, core PCE, you can see in the chart here, it looks like it's coming down a little bit in those core PCE numbers. So that means that some of the things that comprise that, and a lot of those are they're soft goods, things like that, things that you consume. So it's things that are like that are coming down. So it does appear on this chart that some of that is starting to trend downward a little bit. And this is just a short data point. And remember, we're going through these data points. They're looking at this on a regular basis, but really you're looking at trends, and we're talking about trends in quarters and sometimes in half years or years. So this inflation's probably not ending in 2 or 3 months. It's going to be a number of years in all likelihood for it to start to come down. What we're hoping is that it comes down to a slightly higher than normal situation. I think it will be persistent. I'm going to predict this, and that is that I do think that it will persist at a level greater than, kind of the Fed wants it to be. The Fed wants it to be at 2%. So that's kind of their target. The Fed's never been that great at getting to their target. Even prior to that, years prior, they never got up to their target. They couldn't get the economy to inflate enough to their liking. And now
because with zero interest rates, or basically a zero interest rate policy, if you want to look at it that way, that should have kicked inflation in long ago, right? I mean, that was almost the Fed kind of, in a way, taunting inflation, being like, come on, where are you at? And it went so long. And so somebody described this a month ago or so, and I thought it was done in a way that people can understand. COVID may have, we'll never know, but COVID may have simply delayed the inflationary effect that we're seeing right now. This very well could have happened in 2020. In other words, if COVID hadn't happened, right, we probably would have been dealing with the inflationary environment that we have today in 2020.
I think you're right. I'm going to go back to that slide then that we had with those interest rates. So let's go back to the prior slide. And that would indicate that you're correct because you see the Fed funds rate coming up and you actually see inflation coming up as well.
Yep. But what the Fed liked about it was that they were very close to one another, and the Fed felt like it had a good handle on that, right? I mean, I think in a lot of cases, when the Fed's trying to fight inflation, it's almost like when professional bull riders. I mean, you're not going to stay on forever. You just can I stay on long enough to basically get some points out of it, right? And so the Fed, I think at that point felt like they were riding the bull fairly well and had a pretty good handle on it, and then COVID happened and basically just upset everything. They had to go back to zero, lost control of it because they had no choice. And then now we're at where we're at now.
Well, and then we have to talk about it too. The unprecedented sort of the PPP money, the direct payments, everything, just, the stuff when we locked down and we had to keep all these businesses and individuals kind of afloat in this really extreme situation. It really did light the fuse for inflation. And, in our opinion, it's been a big driver of it.
And that's not being critical of the moves that were made during COVID.
Right.
That was a very unprecedented time. The government officials had to do what they had to do at that point. I think that was more about, just putting out the fire and dealing with the after effects of it later. But now we're at later is where we're at.
Now we're at later. Yeah. And if you're being critical, I think if we're being critical of the Fed, we're giving, I would say, let's give credit where credit is due for the Fed to increase interest rates. You saw inflation start to pick up. I think that was like a really good policy there. And then all of a sudden, in the payments, I'm not criticizing the payments. I think that some of them were necessary. I could criticize lockdowns, et cetera, but I'm not even going to get into that. I'm just saying now the Fed was a little slow to move in raising interest rates. And is it politically palatable to raise kind of during COVID? And the answer to that is probably not. And so I know the Fed's not supposed to be a political organization, but as we're giving direct payments and increasing interest rates at the same time, I mean, that's a tough sell to the American public. So the Fed would have really had to step out and do something kind of out there to do this. So we'll see what happens.
And that would have required the Fed knowing that what we have today was going to happen,
right?
Which nobody knew that either. And I think that's let's be critical of our own industry. The talking heads that get on TV shows and try to act like they knew this was coming is absolutely ridiculous. Nobody knew that we would be at 9-1 on inflation. I mean, you and I read, a ton of quote experts. Nobody predicted this, even 6 months ago. There literally was not one person out there saying this. So this idea that today you can say that they knew this was going to happen, that's trying to sell newspapers and books is what that is. That's not being genuine.
That's exactly right. All right, well, let's move forward on a slide that's gonna, let's freak some people out.
If we haven't already, here we go. I think Dan's already hiding under the desk, so we're apparently we've done something well. But we promise with yield curve inversion we won't get lost in the weeds. But it's an important topic.
Yeah. So just to define that, there's a situation where we look at two different Treasury rates, and we look at the 2-year Treasury and we look at the 10-year Treasury. And what would make economic sense to everybody in this room, or hopefully, maybe Dan, I don't know. So the 2-year is at, whatever rate it's at, and the 10-year should be higher, right? Like if I'm gonna lend you money,
yes,
I expect later. If I'm giving Nate Connon money and I'm giving you money and I'm like, Nate, pay me back in 2 years, you're being like, all right, you can pay X amount of rate. Let's call it 3%, just for sake of example, 3%. Okay, great, I'm gonna give you 3. And then I said, hey Nate, I'm gonna give you gotta lend me some money, but I need it for 10 years. Are you going to pay a higher rate? I mean, the answer is certainly yes, right?
You would assume. And again, go back to mortgages, right? A longer mortgage, higher interest rate, right? Car loans, typically. Longer car loan, higher interest rate. So typically this is a pretty common function within markets.
That's exactly right. So there are times, weird times, and we're in the weird times. It's like Stranger Things. That, we go through an inversion where the 2-year rate is actually higher than the 10-year rate. This is kind of... It happens every once in a while. You can see it on the chart. If you see where that 0.08 is on that purple line, you can see the times when it's kind of below that line. You saw it in 1980. Very extreme. Totally extreme situation. So we're not even there yet, guys. So we're fine. You could see it, right there at like 88 or so. And then also, dipping back down, tech bust. That happened. We saw it in like right around 2008, of course, and then now. So usually what this means is when we see a yield curve inversion, usually recession is around the corner.
And or potentially already here.
Or potentially already here, correct. Oftentimes it's, 6 to 18 months away is generally when we see recession. This is what we're talking about, historics. And says it right in the slide, past performance is not indicative of future results. But what I would say is this is a flashing indicator that gives people pause when they see it. And if we break it down to why, it would be like, why would a 2-year bond pay more in interest than a 10-year bond? And that is saying that we have heightened uncertainty. And in many of these cases, not in all, because 2008 was extreme, but there are certain cases where inflation is a big problem there, and they're not anticipating inflation to be a long-term problem, but they're certainly anticipating that inflation is a short-term problem. And so we have this phenomenon that just happened. We can check that box. We checked a couple boxes this year. One, we hit a bear market, check that box. I certainly would say that a 10% downturn in bonds is a bear market in bonds, even though they don't really have definitions for that as much. And then this yield curve inversion is a recessionary indicator. And so, we are saying it is highly likely that you're going to see some sort of recessionary environment in here. That's not driven by like COVID was an unprecedented sort of thing. This could be just a regular recession.
Yeah, and I go back to the point we made earlier in terms of just recession and kind of what an impact it has for people and that kind of thing. Okay, it won't happen tomorrow because it's not how the calendar lines up. But if tomorrow they stated on the headlines, okay, we are officially in recession, nothing will be different tomorrow than it is today. So that's the caution that I have for people is there's going to be no big thing that happens simply because we are officially in recession. And so to that end, don't think that oh my gosh, we have to avoid this thing because if it gets the label of recession, then ... There is no ... after the then. We're experiencing it right now anyways. So whether we're there or not there, we're already experiencing it. We have a drastically negative bond market. We have a as you said, a stock market that touched bear territory. We're already there anyway. Prices are way up. Inflation's a problem. So we're already kind of experiencing many of these things that are recessionary anyways. At some point, they'll put the stamp on it and they'll actually label it recession, but likely is not going to change a great deal based on what we're seeing today.
That's exactly right. And I think the other thing to take away this is the stock market will likely begin its recovery at some point during the recession.
Yes.
So that could happen tomorrow.
Yep.
If we're in recession right now, maybe we're halfway through a recession. Maybe we might see a recession 2 years from now. It might take 2 years. Keep in mind that the market doesn't care about the calendar. So, this could last a year. This could last 6 months. It could last 4 years. We really don't know. Think about the tech bust. We had negative years in 2000, 2001, and 2002, and it accelerated and it got worse and worse each year. That was painful. I lived through some of that. I was an investment advisor when I started then. I got to tell you, that was not my favorite when we had consecutive years that were just down, down, and down. Hey, this could happen again. So we need to just have some resolve when we're investors. We have to realize long-term is actually long-term. We could have lower than expected average market returns over the next 10 years. That's okay. It's all going to be fine, but we just need to make smart decisions. We need to be asset allocators as we always are. We need to rebalance. We need to continue to follow this. And there's always places that you can look at to try to scratch out extra rates of return. Be active with your cash, realize, if you're sitting in a whole bunch of money in money markets or in bank assets, great to have that little extra during a recessionary environment because, job losses, things like that occur sometimes. But make sure you're maximizing your cash investments. Look at I-bonds. There's all kinds of different things that we can do that we can help people with and also that you can help yourself with if you're an investor. But just keep in mind, long-term in this situation, and you'll get right through it. It's not timing the market, it's timing the market. We say that all the time. It's very trite, but it's also a situation where resist the temptation to make huge moves because oftentimes if we get those wrong, that can be catastrophic for your financial situation.
Yeah, we're in a time right now where you have to have resolve. You have to understand that, you know, the market goes through these times. It's a normal course within market investing, and if you invest in the markets long enough, you understand that this happens. It will pay you off historically more than it takes away from you in these markets. The funny thing we like to say is if it didn't work, i.e. long-term growth, if it didn't actually give you long-term growth, nobody would do it. So it is proven over time. It will do what we need it to do. But in most cases, it requires us to just let it go through these periods, get to the other side of it, and then we'll see that recovery. But it's not easy, but it is the right thing to do.
That's exactly right. So I'd like to just thank everyone that's been in the webinar for being with us today. We will, for anyone that's been in the live one, we'll send that out to you. Dan's going to wrap it all up in a nice package and send it out to everybody. And then we'll also post a link on our website as well for anybody to view it whenever they want. If you have any questions, feel free to send us an email at info@walknercondo.com. Any Q&A that we received during it, we slyly went in there and, kind of took a look at that. We got some messages. We've tried to incorporate as much of that into our current presentation as we possibly could. And any additional questions, feel free to make an appointment with any of our advisors, and we're happy to go through that with you. So, thanks for joining us on this. We anticipate doing more of these in the future, and good luck to you as investors in this difficult time.
Stay strong.
Stay strong.
Stay strong.
But we'll know you'll do it.
You'll do it.
Because you have no other option.
Exactly.
All right. Take care. Thank you very much.